uncertain economic environments, rampant banking and stock market scams, capital inadequacies, and a resultant low public trust in the banking and financial infrastructure. This is what characterized the financial ecosystem of our country around mid-1990s. Obviously, not a great time to be in banking and financial services industry in India, right? Well, history has been replete with examples wherein the greatest companies were started in depths of crisis and uncertainty. So before we talk about one such very interesting case study, make sure you subscribe to the channel to help the YouTube algorithm work in our favor. So some of you must have figured out that I'm talking about none other than HDFC Bank, which created history by challenging banking monopolies to become the largest private sector bank in the country and the most valuable bank India has ever seen. Established in 1994 under the able directorship of Mr. Deepak Parekh, it found itself in direct competition with both the public banking monopolies as well as the private counterparts, ICICI Bank and Axis Bank. And then comes the man to which HDFC owes its entire success story, Mr. Aditya Puri, who left his job at Citibank as he was appointed the CEO by Mr. Parekh. He recognized that nobody was doing everything efficiently in the banking sector of India. Public sector banks had scale, distribution and funding capability, but not the right product and certainly not the right customer focus. Reverse was the case with foreign banks, which had customer focus and product but no meaningful distribution network and funding capability. It was this gap that Puri wanted to disrupt by putting together a great team to build a bank that truly understands your world. It was tough to get people on board. He was aiming high, the absolute best people he could think of in India and overseas, with the sales pitch of asking them to join what would become the best bank in India, but wasn't yet. Eventually, he made successful key hires from Citibank, Bank of America and HSBC, thus building a strong team. Since the bank was still at a very nascent stage, it had to identify certain niches to go big. It started with solving check settlements for cooperative banks. Back in 1998, the cooperative banks were restricted to one state, which hampered the process of interstate transactions. Let's say there's Rahul in Rajasthan who wants to transact with Shyam from Maharashtra. Rahul shall give Shyam the check of his cooperative bank, which Shyam would get deposited in his bank. Shyam's bank then would send the check to their partner bank in Rajasthan to settle the payment, which would actually take a number of days. Thus, the process of check deposit and fund settlement in case of cooperative banks was a long drawn process, which actually extended the payment cycle and consequently led to greater working capital needs for merchants and businesses. As a result, most of these customers didn't actually want to have a cooperative bank account. HDFC Bank solved this issue for cooperative bank by enabling their customers to deposit checks in any branch of HDFC Bank with rapid settlement and no processing fee. This enabled such cooperative banks to retain high-value clients, which was significant for their business. For providing this facility, HDFC Bank asked such banks to park some of their funds with them at no interest. Clearly, a very intelligent move. It enabled HDFC to procure a large amount of low-cost funds for lending, which eventually helped them to offer the best lending interest rates. Since you're watching this video, I'm quite sure that you're interested in knowing how to read and analyze a company. Since that is the case, I have some good news for you. We at Upsurge have curated a complete course on fundamental analysis, where we cover in-depth topics such as reading financial statements, doing valuation analysis, the right way of picking multi-bagger stocks, and whatnot. The best part? This course is curated by Mr. Namaskar Prasad, who is a famous YouTuber with 20 lakh subscribers and is known for his fundamental analysis. So before you continue watching this video, make sure you click on the link in our description below and enroll for the course. Similarly, innovation in the share settlement process by making it low cost and rapid, 2 to 3 day settlement as against 5-6 days earlier, enabled HDFC to tap into a consistent stream of low cost funds by making it mandatory for all users who wanted to avail such services to open their accounts with HDFC Bank. In both these cases, we see how innovatively HDFC positioned itself in a way to exploit the market opportunities to their best interests. However, this doesn't end here. HDFC also wanted to establish its strong foothold in the corporate banking segment. It believed that it could do so by innovating on two fronts: low-cost fund acquisition for lending, providing innovative and customer-centric banking services. But it being a relatively small bank couldn't offer high ticket size loans to corporates. This did not stop them. Rather, they shifted their focus to an underserved segment: transactional and cash management business for corporates. They actually revolutionized how corporate salaries were paid by creating innovative centralized system of fund transfer. Until then, there used to be a huge time lag in getting their salaries credited, but HDFC made the entire process streamlined and automated. Again, this mechanism required that all salaried people availing of this facility must open their accounts with HDFC. By then, it was evident that they were solving some real pain points, and so customers were more than willing to switch to HDFC. Thus, HDFC Bank focused on the very basics of how banking business works. All what they optimized for was cost of acquisition of funds by increasing their CASA, current account savings account ratio. No interest needs to be paid on current account, while a minimal interest needs to be paid on savings account against a fixed deposit, which requires a higher interest rate. In the year 2000, their CASA ratio was 46% versus just 20% for other banks. This boosted their net interest margins and return on assets. A large number of account openings also cemented their position when they decided to enter the retail banking segment after 2000. They were the first Indian bank to provide mobile banking solutions and also facilitated POS facility. With a strong semi-urban and rural presence, they have a 60% market share in the middle market segment. They are also market leaders in electronic card payments with a 50% share in overall volumes. Most importantly, it enjoys the best-in-class portfolio quality across asset categories. It is this very reason that it boasts of a gross NPAs of 1.17% and net NPAs of 0.32%, which is around 3 times and 2 times better than that of its closest counterpart, ICICI Bank, respectively. It is believed that the banking sector grows around 2.5 times the growth in economy due to the multiplier effect. With India's growth rate pegged at around 8%, it implies that banks must grow at 20% annually. HDFC Bank has actually held on to this 20% growth principle. Its advances have witnessed annual growth of more than 20% in the last 17 out of 20 years. Moreover, its annual net profit growth has been more than 20% in the last 18 out of 20 years. It has also delivered amazing returns to its shareholders. Rupees 1000 invested in HDFC Bank in 2000 would have returned over Rupees 81,000 today. Hence, HDFC Bank adopted a three-pronged strategy, which serves as a great business lesson as well. This propelled its growth to become the largest private sector bank. First, finding a niche and building for it. Having started small, they did not do what the big players were doing without being thrashed. Rather, focused on solving one inefficiency at a time. Second, perfect risk management. Banks are in the business of maximizing returns by optimizing risks. If they can do it well, there's no stopping them. It is this very reason that while other banks were struggling during the global financial crisis 2008, HDFC, which had its exposure to low-risk borrowers, did not suffer. Lastly, constant innovation. Mr. Puri always had a big vision for HDFC, which made him think far ahead of time to come up with the best possible solutions. Truly, a once-in-a-century business story. Almost every portfolio that HDFC has been into has turned it green. If you have invested in HDFC, you sure have experienced growth. And if you want us to do that as well, then you might want to like and share this video.